Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm joined today by Bruce Brammall, our superannuation editor, to talk about the latest superannuation changes. Welcome, Bruce.
Thanks, Tony.
Bruce, we've had a chat on some previous segments about the changes coming in. One thing we haven't talked about is a change relating to transition to retirement pensions. Just wondering if we can have a run through of what those changes are, Bruce.
Yeah. Look, for the first time ever, Tony, they're going to tax a pension fund. Essentially, it'll be taxing transition to retirement pension funds. So these are people who are 55 or older, who've turned on a pension, but are taking a pension of between 4 and 10%, but haven't met a full condition of release, being age 65 or 60 and changing employment. So they're on a transition to retirement pension. They can take minimum 4, maximum 10%. That fund itself now is going to be, from July 1 next year, is going to be taxed for the first time at superannuation tax rates. So that means 15% on income or effective tax rate of 10% on capital gains. So it's going to change, whether or not it's worthwhile for some people to have a transition to retirement pension. What does that mean? If you've got $500,000 in your TTR fund and that's earning 5%, there's $25,000 in income or taxable income that the fund has earned. You're now going to pay 15 or 10% tax on that. So there is going to be a cost to it. It might not be enormous. Obviously, the bigger the pension fund, the more tax you're going to pay on the bigger the earnings that it's earning. But it is going to make it slightly more marginal for some people as to whether turning on a TTR is worth it or not. The income stream that you receive from your pension fund is still going to be tax-free if you're over 60. So if you've got that $500,000 fund and you're drawing up to 10% or somewhere between $20,000 and $50,000 a year in income from that, the 4 to 10% mark, then that income itself is going to be tax-free, but it's the earnings on the pension fund itself that will be taxed for the first time.
So as a strategy to salary sacrifice while you're still working, putting money into your super and then pulling that out as a pension, is that still viable?
Yeah, look, it can be, again, needing to take into account the how much tax is being paid by the pension fund itself. But interestingly, this is going to be one where the smaller your pension fund, the more advantage that you're potentially going to be able to take from this. If you only have a pension fund of $200,000 and you're drawing 4% from that or $8,000 a year, but you've got the capacity to put in up to the $25,000 limit that will exist from the 1st of July next year, then you can get in a lot more money than you're actually going to be drawing from the fund. And $25,000 in, less your 15%, and you're only drawing $8,000 as a minimum pension out. But on that $200,000, what has changed is what's going to be taxed on the income of that $200,000. Again, if you call it 5%, and the $200,000 fund is earning $10,000 a year, it's going to pay $1,500 in new tax that hasn't been paid before. So $25,000 in, less the 15%. $8,000 coming out as a pension payment, and then this new tax of $1,500. So it's all going to change. If you've got a very big transition to a retirement pension fund, then the tax that's being paid on the pension fund itself is going to be the one that is ultimately going to cost a lot more. So people with smaller pension funds are actually going to be in a better position out of this, or comparatively better position to those with much larger pension funds.
Yep. And as always, everyone's situation is different, so people do need to seek out financial advice if they want to look into these strategies.
Absolutely. We had a beautiful period for 10 years of where superannuation and the rules surrounding superannuation, you could figure it out. If you sat there and you worked at it for long enough and worked out your position, it would become clear to you reasonably quickly what would be advantageous and what's not. It's now gone back to being horrendously complicated again, and that as of the 1st of July. So it's going to take a lot more work and spreadsheets and the like. But yeah, absolutely, to find out what's going to work out best in your position, get proper financial advice.
Well, thanks again, Bruce. Thanks for coming in. I'm Tony Kaye. I'm the editor of Eureka Report.